Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Phil Mackintosh, chief economist at Nasdaq, for a look at market performance. We'll also talk about some potential headwinds that the Fed might face when it comes to raising rate hikes here. Phil, it's great to see you. And let's talk about recent market action. It just seems like the macro hits keep coming and coming.
Yeah, it's been a tough couple of weeks for the markets, hasn't it? And if you look at rates, the 10-year rate's up about 40 basis points in short order in about 4 weeks, which is a lot. It's back above the highs that we hit last year. It's getting close to 1.9%, which is a big increase on where we were in December, closer to really 1.4% at times. So that is, we've always said, going to be a headwind for markets, and it's proving to be a headwind right now. I think a lot of the reaction is just the Fed's pivot, and some of the rhetoric coming out from some of the Fed governors right now is much more hawkish than it was a few weeks ago. And so even though the market had kind of priced in rate hikes, now I guess it's for real.
And Phil, let's talk about the consumer for a moment. You did some really great work in your morning note when you looked at consumer spend and savings rates and how this could potentially translate into Fed policy. We'll get to that in a moment, but what are you looking at as it relates to the consumer and GDP specifically?
Yeah, so we've talked about how retail sales really powered the booming economy last year, and December was a little disappointing. So retail sales dipped a little bit more than expectations. One of the theories is that because everybody knew there was going to be shortfalls and supply chain problems, they shopped early. But of course, it's also possible that people are starting to slow down on their spending. If we actually adjust the retail spending for inflation, in terms of the amount of goods being bought right now, it's actually back to trend. So even though the total spending numbers are still pretty close to records, because you can't buy as much with the same amount of money, the amount of goods being bought is actually back down pretty close to trend. So that's an interesting thing to observe. And to your point as well, part of what's going on is people are running out of their stimulus savings. And so we're starting to see that with the savings rate every week now. And we've seen, even though there's a couple $1 trillion worth of savings that people have accumulated, there's data showing that that's mostly with the higher income households who typically don't spend it, at least not in a hurry, because they've got more savings as well.
Right. And then, Phil, when we think about potentially 4 rate hikes, as a number of economists and strategists think we can get in 2022, should the consumer get weak and that impacts GDP, that could potentially be a headwind in terms of Fed policy and how they're teaming inflation and managing their interest rate policy.
I mean, it could make it easier for the Fed too, though, couldn't it? If we're freaking out this week because suddenly interest rates are rising because the Fed's for real, and then suddenly the consumer slows down on their own, we might get halfway through the year and the Fed's like, actually, you know what? The consumers slowed down on their own. This is not as, like, the inflation threat is not as strong and not likely to be as persistent. And we've talked about this, right? If people stop buying goods, then the goods price inflation should come down a bit. If COVID goes away and people start to come back to work, doing more services spending, then that should help as well. It should take some pressure off wages. And so there's sort of 2 things happening slowing the economy down. One is the Fed purposely, and the other is the consumer, maybe subconsciously. And they could both work at the same time. The risk then, I guess, is the Fed makes a policy mistake by committing to too many rate hikes when the consumer is already slowing things down anyway.
Well, time flies when you're having fun, Phil. They've got 6 weeks to figure it out until March, when the first rate hike is expected to take place. So it'd be interesting to see what happens there in just a few weeks. Thank you for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.